Hello class 10 and welcome to your economic application class. This is your Nigam sir and today the lesson that we are going to learn is commercial bank. The objective of this video is to study about the definition of commercial bank, the features of commercial bank and its major functions. Now let us know the definition of commercial bank. Commercial bank are those banks which perform all kinds of banking functions such as accepting deposits from the public, advancing loans and credit to the public, credit creation and financing trade and commerce. All the commercial banks of India have to register themselves under the Banking Regulation Act of 1949. So a commercial bank is a financial institution that accepts deposits from the public which can be withdrawn by checks or through ATMs. And normally the bank uses this money that they have collected to give credit or loans to those who are in need. The examples of commercial banks are State Bank of India, Allahabad Bank, Bank of India, United Bank of India, Axis Bank, and many more. There are different types of commercial bank in India. They are public sector banks, private sector banks, and the foreign banks. The public sector banks are those banks which are owned and controlled by the government. Private sector banks, on the other hand, are those banks which are owned and controlled by the private people, while foreign banks are those banks which are owned by the foreigners. Now let us understand the features of commercial bank. The first one is that it deals with money. It accepts deposits and grant loans to the traders for a short period of time on a rate of interest. The second one is that it is a commercial institution. Why? Because its main aim is to earn profit. The third feature is it is a unique financial institution which creates demand deposits which serves as a medium of exchange. So, commercial bank is an institution which accepts that type of deposits which can be withdrawn by the depositor as and when he requires through checks or through ATMs. The fourth feature is that it deals with the general public. Now let us understand the functions of commercial bank. There are two functions of commercial bank, primary functions and the secondary function. The primary functions are accepting deposits from the public and granting loans to them. The secondary functions are agency functions and utility functions. Now let us understand the different types of deposits that are accepted by all the commercial banks. There are altogether four types of deposits. They are current account deposits, saving account deposits, fixed deposits, and recurring deposits. Now let us understand in detail what are these deposits. Current account deposits, also known by the name demand deposits, are those deposits which can be withdrawn anytime by means of check. So these deposits are normally opened by the businessman or the trader because they are always in need of money, and in this type of deposits there are no restrictions on the withdrawal of their money. So that is why this type of deposits is very suitable for the businessman. Under this deposits there are no interest paid by the bank. Rather, the depositor has to pay some charges to the banks for their services. Now let us move to another type of deposit, that is the saving deposits. So these deposits are normally opened by the household. Your parents, your friends also have opened this type of deposits. So saving deposits are those deposits on the withdrawal of which bank places certain restrictions. The check facilities are provided to the depositor. This type of deposits are opened by the household who have idle or surplus money with them. So what are saving deposits? Saving deposits are those deposits which are meant for the household who have idle money or who have surplus money with them. Usually under this deposits interests are paid to the depositors, and these depositors can withdraw their money through check or through ATMs, but there are certain restrictions on the number of withdrawal during a month. The another type of deposit is the fixed deposits. Fixed deposits or time deposits are those deposits which can be withdrawn only after the expiry of a certain fixed period. This deposit carries the highest rate of interest. The longer the period, the higher will be the rate of interest. So what is fixed deposits? Fixed deposits are those deposits which are deposited for a certain period of time by the depositor, which cannot be withdrawn before the expiry of that period. For example, a depositor can deposit a certain sum of money for 6 months or for 1 year, and he cannot withdraw the money before that period. Now let us move to another type of deposit, that is recurring deposits. Under recurring deposits, money is deposited in monthly installments, say rupees 2000 for a fixed period of time, say 2 years. So what is recurring deposits? Under this deposits, the depositor normally deposits a monthly installment for a certain fixed period of time. Okay, and the depositor cannot withdraw this money before the expiry of this fixed period. The main objective of this account is to encourage the regular saving habits among the people. The deposits are accepted by the bank at a regular interval of time, maybe on a monthly basis, or a quarterly basis, or on a different basis or a different time period basis. Now let us move to another primary function, that is the granting of loans. The bank advances loans of different kind. The first one is the cash credit. Now let us know what a cash credit is. Cash credit is a type of loan which is given to a borrower against the securities like shares, bonds, stock of goods, etc. So what is the cash credit? Cash credit is just like a loan which is given against the collateral securities. So under this, what happens is that the banks opens an account in the name of the borrower and allows him to withdraw the money through check as and when he requires. But under this type of loan or under this type of advances, the bank charges interest not on the entire amount but only on the amount that is withdrawn by the customer. The second type of loan is the overdraft. This type of facility is given only to the current account holder. So what happens in overdraft is that the customer gets the privilege of withdrawing the money more than that he has in his account. Suppose if I am a current account holder and I need money of rupees 10,000 and I have only rupees 8,000 in my current account, then I have the privilege of withdrawing rupees 10,000 from my account. So that 2,000 extra is what is known as overdraft. So I have over withdrawn rupees 2,000 from the bank. So that is what is known as overdraft. And I, as a current account holder, have to pay interest only on rupees 2,000. Now let us understand what do you mean by short-term loans. Under this, whenever a customer takes loans from the commercial bank, he will be opened an account in that bank and the sanction amount will be credited in his account and he can withdraw the money as and when he requires. And the bank charges interest on the whole amount from the day it was sanctioned. So this is what short-term loans is. Now let us understand what do you mean by discounting of bills of exchange. Before we understand the discounting of bills of exchange, let us know what do you mean by a creditor and a debtor. A creditor is a person who lends money to someone, while a debtor is a person who borrows money from someone. So, a bills of exchange is that instrument which is usually drawn by a creditor on the debtor, specifying the amount to be paid and the date when it becomes payable. So, such bills are usually issued for a period of 90 days. And in between, if the creditor needs money before the expiry of 90 days, he can sell it or discount it with a commercial bank before the expiry of 90 days. So, in that case, the banks make the payment to the creditor after deducting the commission. And when the bill matures, that is after 90 days, the bank will receive payment directly from the creditor. So that is what is meant by discounting of bills of exchange. That is, creditor sells the bills of exchange uh, to the bank, and normally the bank gets the payment only after a shortened period of time from the debtor. So, in this video, we studied about the definition of commercial bank, its feature, and its primary functions of commercial bank. So, this is at the end of this video. If you have any queries, then we can discuss it in the WhatsApp group. Thank you, everyone, and thank you for watching.